Hey everyone, welcome to today's deep dive. If you're just starting out on your wealth building journey, you've absolutely heard this classic debate: real estate or stocks. I mean, the real estate folks will swear up and down that cash flow is king. Meanwhile, the stock market camp, they'll tell you compound interest is literally all that matters. And usually people just pick a side based on pure emotion, or let's be honest, whatever hyped up advice they saw on social media. But putting on my financial advisor hat for a second, I'm here to tell you we need to look at the actual numbers. In this explainer, we're going to cut through all that hype, expose the hidden costs nobody talks about, and build you a real, honest investment blueprint based purely on the math.
Okay, let's dive into this. Here's our roadmap for today. First, we'll compare the two investment choices. Second, we'll uncover the hidden real estate costs. Third, we'll look at the power of compound interest. Fourth, we'll establish some practical investment conditions. And finally, we'll build the optimal combination strategy.
Section 1. Two investment choices. To kick things off, let's set up a perfectly fair scenario between two guys, Jake and Marcus, starting from the exact same financial spot.
So Jake and Marcus are both 30 years old, making $55,000 a year, and they've both managed to save exactly $50,000. But here's where their paths completely diverge. Jake takes his $50,000 and drops it as a 20% down payment on a $250,000 rental property. Psychologically, this feels amazing. His asset is tangible. He can literally drive past it and feel like a total boss. Meanwhile, Marcus takes his $50,000 and drops it straight into a broad stock market index fund. Plus, he sets up an auto invest of $300 every single month. Marcus's investment is invisible. It's abstract. And honestly, it's incredibly boring. No shiny keys to hold. But as you'll see, this massive difference is going to dictate the next 20 years of their lives.
Section 2. Hidden real estate costs. Let's fast forward to year 3 and see what actually happens to Jake's rental income.
Let's really look at the math here, because this strips away the illusion of cash flow. On paper, Jake's gross cash flow over these 3 years looks like a sweet $16,920. That's the flashy number you see on YouTube thumbnails. But let's check the true costs. Property taxes, $9,000. Insurance, $4,500. Oh, the water heater blew up. That's $1,200. A roof leak? Goodbye to another $2,800. Throw in a month where the place sat empty and the fees to find a new tenant, that's $2,400 more. When you actually subtract all of that, Jake's real net cash flow for 3 whole years is a measly $2,000 to $4,000. Yeah, you heard that right?
And this right here is exactly why, as a financial planner, I am constantly warning beginners about hidden costs. Literally nobody factors in the 1 to 2% in annual maintenance or those massive capital expenses, CapEx, like replacing an entire roof. Think about it. If you hire a property manager, bam, you instantly lose 8 to 10% of your revenue. And if you decide to manage it yourself to save a few bucks like Jake did, congratulations, you just took on an unpaid part-time job dealing with midnight plumbing emergencies and nightmare tenants. These costs don't show up in those theoretical online calculators, but they absolutely drain your actual bank account.
Section 3. The power of compound interest. Let's shift gears and check in on Marcus's stress-free strategy.
So while Jake is pulling his hair out over a leaky roof, Marcus is doing absolutely nothing. Year 1, his account bumps up and down a few $1,000s. Honestly, it doesn't feel like much. But jump to year 3. Thanks to that steady $300 a month and historical average returns, his portfolio hits $76,000, and he hasn't spent a single minute managing it. By year 7, the compound growth really starts catching fire. His gains are making their own gains, pushing the portfolio to $150,000. And by year 10, the pure compound growth, just the money his money made, actually equals the equity Jake has in his house.
Now, what's really interesting about this slide is understanding exactly why Jake is still in the race, despite all those crazy repair costs. It all comes down to one word: leverage. Jake only put in $50,000 of his own cash, right? But he gets the appreciation on the entire $250,000 property. That 5-to-1 leverage ratio, that is real estate's absolute superpower. It amplifies your gains, and it's honestly the primary reason property creates so many millionaires. I mean, we can't deny it. That is a massive point for team real estate. But here is the ultimate twist. Let's look at where our two guys end up after 20 years. Jake's rental property is now worth around $450,000 to $500,000, and he's paid off most of the mortgage. Meanwhile, Marcus's boring stock portfolio? It's sitting right around $440,000 to $460,000. No way, right? They end up with almost the exact same net worth. But the real cost? Totally different. Jake literally worked for his wealth for 2 decades, sacrificing hundreds of weekends. Marcus? He just waited for his wealth. And the contrast gets even crazier when we talk about scaling up. Say Marcus wants to get even richer. All he does is tweak his auto invest from $300 to $500 a month. Just $200 extra, and over 20 years, compounding skyrockets his portfolio to $600 grand. It's literally just changing a number on an app. But for Jake, if he wants that same growth, he can't just invest a little more. He has to buy a whole second property, take out a massive second mortgage, find more tenants, and literally double his workload overnight.
Now, to be completely fair and objective here, I have to point out the brutal reality of index funds. You don't have to work hard, sure, but you need a stomach of absolute steel. Volatility is no joke. Imagine logging in, seeing your portfolio at $150,000, and then in just 4 weeks, like back in March 2020, it plummets to 95 grand. That is gut-wrenching. And the data shows a lot of retail investors totally panic and sell at the very bottom, locking in their losses. Stocks are a mental game of discipline. They don't give you monthly spending cash, and they definitely don't offer the tax leverage you get with real estate.
Section 4. Practical investment conditions. Time to lay down some ground rules.
This is the absolute most important number you need to remember if you're buying a rental. 0.8 to 1%. The monthly rent in your local market must be at least 0.8 to 1% of the purchase price. So if you're buying a $250,000 house, it has to rent for at least $2,000 to $2,500 a month just for the math to work in your favor from day one. If your market doesn't hit that ratio, you aren't buying an asset. You're buying a liability and a whole lot of stress.
The core philosophy I want to drive home is this. Pick the asset class that actually matches your temperament, not just whatever is trending on social media. If you know your local market inside and out, have the time to manage things, aren't afraid of DIY repairs, and can stomach unexpected bills, real estate is fantastic. But if you crave simplicity, want safe diversification, need high liquidity, and refuse to spend your weekends playing landlord, index funds will build you just as much wealth, if not more, with a fraction of the headache.
Section 5. The optimal combination strategy. Because honestly, who says you have to pick just one side?
Here is your exact blueprint for combining both. Step 1, secure and protect that initial capital, your $50K. Step 2, whether you buy a house or not, set up an automatic monthly transfer of $300 to $500 into a broad index fund. This guarantees you're constantly capturing the magic of compound interest without even thinking about it. And step 3, if you do buy a property to get that sweet leverage, you absolutely must budget every single month for a CapEx reserve fund to handle those major repairs. Doing this safely diversifies your money, capturing both the leverage of property and the effortless compounding of stocks.
So, the crucial point is, when you're evaluating any investment, never just ask which one has higher average returns. Ask yourself if you factored in the whole picture. The answer that includes absolutely everything, from taxes to maintenance to the sleepless nights over market crashes or leaky roofs, is the only answer that actually matters. You have to look past the flashy thumbnail numbers.
All right, that wraps up our deep dive for today. We've gone from financial fantasies right down to the nitty-gritty spreadsheet reality. And I really hope this gives you a clearer view of your own roadmap. I'm going to leave you with one final provocative question. Are you going to be a Jake and work for your wealth, a Marcus and patiently wait for your wealth, or are you going to be the ultimate optimizer and brilliantly combine both? Think about that as you chart your financial future. Happy investing, everyone!